I'm joined by Kathleen Brooks. She's the research director at Forex.com. Hi there.
Hi.
Are we making progress ahead of the big meeting on Thursday and Friday? We seem to be, don't we, within Europe?
We do. They seem to be talking in a very unified voice, which for the euro area is definitely a good thing. Added to that, obviously there is a little bit of disappointment because earlier in March we had expected them to actually be able to go and use the bailout funds to actually go into the debt markets. However, the currency markets seem to have brushed that off at the moment. It's still causing a bit of a wobble in the credit markets, but at the moment it looks like we are moving towards something that the market will at least be pleased with, because they can breathe a sigh of relief that there is the money, there is the financial backstop there that can certainly deal with Portugal and potentially even deal with Spain.
Interest rates, is that the primary factor driving the euro right now?
Yes, it is, absolutely. And that's why, even though the fund might not necessarily deliver everything that the markets had been looking for, and the euro is still incredibly strong at the moment. I mean, it's getting hit a little bit at that 142.
142. I mean, what are the key levels around here? Is that the key level, 142?
142, then you need to go to 142.40. Once it gets above there, 142.80 is the top of trendline resistance. So if we can break above there, have a daily close above there, that would be very, very bullish signal. And that's all being driven by interest rate expectations. So when we hear ECB's TRICHET come out and pretty much reiterate the fact they will probably hike rates next month, that's really what's driving this currency.
There were some doubts post the events in Japan that the ECB would go ahead and hike rates, but it does seem like it is a done deal, doesn't it?
Absolutely, yeah. I mean, the rhetoric that's come out, not just from TRICHET, but from some other members as well, like Maj came out yesterday, has been very much that they're still going to stick to their guns. They're going to stick to the plan that they discussed before the Japan earthquake during their meeting at the start of this month. So it looks like those fears, they're going to be put to the back at the moment. I mean, this is only probably a 25 basis point hike. TRICHET was very clear in saying it probably wouldn't be the start of a tightening cycle. So in that sense, they don't necessarily have to worry about the external factors.
You mentioned Japan. As we know, the G7 intervened on Friday for the first time since 1990 as a group. The yen's around 80.98. I hear that there isn't an official line in the sand, but 80 could well be it. Might we see further intervention by the G7?
Oh, I think that absolutely we will. I mean, the first round of intervention on Friday was very, very small, really, 25 billion in a $4.5 trillion a day market. So they're going to have to continue to keep stepping in and talking with a very unified voice, I think, so that the market goes with them. Because, you know,
will the market go with them, though? I mean, as Japan's insurers and as individuals repatriate their funds, I mean, are you fighting a tide here then, an unstoppable tide?
I mean, that argument is very strong. However, what we've seen in the past is that these centralised interventions from the whole of the G7 can cause maybe a year or even a year and a half of kind of bouncing around level. But what it does, it installs a floor. So we think that floor is about 80. And then even though we don't expect it to go to kind of 95 anytime soon, it could potentially in the next kind of year or so, because this intervention has a psychological impact rather than a real impact. As long as the market psychology is that, you know, the floor in the yen is at 80, then we could see a much weaker yen over the next medium to longer term, so say 2 to 5 years.
Kathleen, thanks for joining us today. Kathleen Brooks there, research director at Forex.com.